Yeah, thank God, so over there. Yeah. Where's Paul? There's TME. Morning, everyone.
Morning.
I'm Kimberly Clark. I'm from the public.
We're still waiting on Paul. I haven't received a message from him, so. Hopefully we're in the right link. I mean, it's just weird for Paul not to be here.
I went to the link that was in the invite and it said that you were in another meeting, so I had to go to the website and then.
Yeah,
agenda.
I know.
I just did
It's,
the calendar link.
Yeah, so we gotta fix some stuff here because this has been a constant problem, making sure we're in the right meeting when I log into this thing, so.
Morning, everybody.
Hey, Chapin.
Nick, I turn into a pumpkin at 8:20, unfortunately. So,
Okay,
but I'm here for that.
okay,
Nick, I'm basically by phone for this one because I've got to
Okay.
be somewhere by 9 to meet with the legislator. So
okay. Wondering where Paul is, so. He's not here. I don't think we have we do have a quorum, actually. Chapin, well, you gotta leave at 8:20. Here comes.
I can facilitate until I have to leave and then we transition to somebody else. I'm flexible.
Yeah, well, if no one else comes, we lose quorum at that point, so, I mean, we do have an action item today. It's not necessarily required that the finance committee weighs in on it, but it would be helpful. It's the capital budget adjustment, so I may ask that we adjust the agenda so that Matt can go first and present the capital budget adjustment, and that at least can get voted on. So yeah, Chapin, why don't we go ahead and get started? And do you have the agenda in front of you?
Yes, I did. Give me 2 secs and it's right here. All right. So as a member of the Finance Committee, without Paul here, I'll call the Finance Committee for September 11th to order. Are there any adjustments to the agenda?
Oh, yes, well, I'm not technically a member of the committee, but staff would recommend moving the FY 25 capital budget adjustment up for the grants presentation if possible.
Great. So we'll move that up to after public comment. At least that's the proposal at this point. Any other adjustments? All right. Well, then I'd welcome a motion to approve the agenda.
I don't think we need a motion to.
All right.
Well,
You mean to make the adjustment to the agenda?
Yeah.
yeah, I'll make that motion.
I'll second it.
All right. Thank you, Susan, for seconding. Any discussion? All those in favor say aye.
Aye.
Any opposed? All right. The ayes have it. So thank you. We have an agenda. Public comment. Is there any member from the public, either in person or online?
Kimberly Clark. I'm from the public.
Okay, Kimberly, you can proceed.
Can I say something?
Yes, you may.
I recommend the GMT board to have John Moore take over general manager at Green Mountain Transit.
Okay. Thank you, Ms. Clark.
You're welcome, Chief Spencer.
Yeah. Is there anybody else who would like to speak?
None in the boardroom.
Okay. then we will close public comment and move on. Actually, yes, why don't we head to the capital budget? I said that would happen after public comment, and then we'll approve the minutes right after that. Those are the two action items. So hit it, Nick or Matt.
Yeah, I can jump right in. So there was a memo in that Nick sent last week. I can share my screen. Fortunately, I'm working out of a hotel, so I don't have multiple screens that I would normally use to facilitate that. But here's the memo that was included with the material. So the change is pretty straightforward. We had funding, or we had two cutaway buses in our rural capital budget that were going to be paid with 100% local funds. VTrans, in one of our amendments to the state grant, actually provided us with $270,208 in federal funds to purchase those vehicles. But that had not made its way into the capital budget, which we discovered at year end when we were closing out our billing and build those buses. This proposed change would be to to capture those federal funds in the capital budget for those for that line item for two cutaways, and which would reduce the local capital match by that same amount, that $270,208. And that would correct the capital budget, which we are using to reconcile the local capital match at year end. So I can scroll down to the line item just because that makes it a little bit more clear. So that local match goes from $337,760 down to $67,552. That was all coming out of the local capital match fund. So we end the year with $354,513 coming from that fund, as opposed to over $600,000, which the previous capital budget reflected. So I will stop sharing, and that's the only adjustment. So staff is looking for a recommendation from the Finance Committee to the board for adoption.
Great. Matt, thank you for that. Any comments, questions? Don't everybody speak at once. Okay, well, if there's no comments or questions, is there a motion?
I move we adopt the capital budget as recommended by staff.
Thanks, Austin.
And I'll second that.
All right, Susan seconds. You two are a good team this morning. Is there any discussion? All right, all those in favor say aye.
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 Aye. Any opposed? All right, the ayes have it. Matt, thank you for the presentation and that correction.
Thank you.
All right, moving expeditiously to the minutes from August. They looked good to me. I'd welcome any edits or a motion to approve. Any comment on the minutes from August?
Move we accept the minutes from August.
Okay.
I'll second. I wasn't at the meeting, but I'm happy to second that motion.
That's great, Susan. I appreciate that. All right, any discussion? Hearing none. All those in favor say aye. Aye.
Aye.
Any opposed? All right, the minutes are approved from August. Director of Grants update. We are humming.
Yeah.
You bring it up on the screen.
Yeah, here, let me hit. Gonna pull it up right now. And Paul is joining momentarily.
Excellent.
Let's go. Oh, we gotta share the screen. Yeah, why don't you wanna just tell me when you want me to switch the
Okay.
let's see. The share. So more. No, it's the share button. More, okay. Share.
Modern technology, it's always so fun, isn't it?
You should go back to in-person meetings, every single one. Can all of you see this?
Yes, we can.
Okay.
You wanna do slideshow
great.
from the beginning?
Yeah, I'm gonna see it.
Slideshow, just go up to the top.
No,
But yeah, go to slideshow at the very top.
slideshow at the very top.
Yeah, and then go from beginning.
Perfect, go ahead.
Okay, so, I wanted to present to the finance committee, where we stand with our direct federal grants. We can certainly, at a future finance committee meeting, we can talk about our pass-through grants as well, but just wanted to give the group an understanding where we stand. We're actually in, pretty good shape with all of our direct federal grants. Everything that's available to us is obligated and active. Any grants that don't have any unliquidated balance left have been closed out, which is something that the FTA looks at very closely, the Federal Transit Administration, to ensure that we're closing out grants that are inactive or don't have a liquidated balance remaining. You can go to the next screen, just talks about, is it not working for you?
No, it's ever working. There.
Yeah, so this, you can go past that page now. So currently GMT has, around $11,929,564 in unliquidated federal funds. We were awarded those funds through the Transit Award Management System, where I build the grants, the applications, and submit them to the FTA. It's a pretty long, tedious review process, and then once those are approved, they become obligated to us and we can start drawing funds against them. One of these active grants that we have is the 5309 grant that we are working with the FTA to repurpose those remaining unspent funds to support ITS improvement projects. You should have received a separate spreadsheet that I provided. That's a lot more detailed. I just don't have time to run through that whole thing today, but if you have any questions about that supporting detailed sheet, please let me know. FTA has asked us to refine the scope for consideration. Matt and I are working on that to submit to the FTA. I'm not quite sure if they're gonna allow us to change all the scopes that we requested. That's defined in that detail sheet, but that's yet to be seen. One of the other older grants we have is the grant that we use to purchase 31 Queen City Park Road, which is adjacent to our building. We're also using those funds for renovations, engineering, design. So that's an active grant. At the period of performance on that grant, period of performance is when you're supposed to have all the projects completed. So the period of performance had lapsed, but they granted me and Matt an extension on that until June 30th of 2026. Not sure if we can wrap up all those projects by then. If we can't, then Matt and I will request another extension from the Federal Transit Administration. But for now, they have approved the initial extension so we can continue work on that grant and projects associated with that grant. Okay. You could go to the next screen. So V-Trans transfers a significant amount of federal highway funds to GMT annually to support our operations. 4.8 federal in the FY26 urban grant agreement. GMT currently has one active flex grant for eligible routes, expenses, preventive maintenance, and capital expenses. We exhausted the older grant in April of fiscal year 25 and have a remaining balance of 2.5 million federal in the active CMAQ grant to support eligible expenses for FY26. We estimate that those grant funds will be exhausted somewhere in the beginning of 2026. And Nick and I are looking at it more closely, and it might get us through March. It might only get us through January. V-Trans is aware of this. We're actively working with V-Trans on that, and they're trying to expedite that next flex transfer. Once they've completed the flex transfer, then I could build the grant application in trams and get those funds obligated by the FTA. So hopefully there won't be that much lapse in time. What generally happens is we accrue those expenses when we run out of funds to draw down. Sometimes it could be 3 or 4 months of accrued expenses. We're hoping to minimize that to maintain adequate cash flow. So that covers that. I think you can go to the next slide. Okay, yeah, this is it. GMT has 2 active grants that support our small urban transit system. Monthly operating ADA and preventive maintenance expenses. ADA is Americans with Disabilities Act. And we have to use 10% of those formula apportionments to support the ADA program. These grants are annual 5307 formula apportionments awarded to GMT. Currently, we have 1.2 million federal remaining in the older formula grant. We estimate that'll be exhausted in August of 25. That grant has 50% local match requirement. The newest formula grant has not been used yet, but we estimate it will cover operating expenses for the remainder of FY 26. So generally the apportionments come out in the spring, and my plan is that once we have those apportionments available to us, that'll be posted on the FTA website, then we'll immediately apply, submit the grant application through trams to the FTA to get those funds obligated to us in that grant active. GMT did use $529,000 in FY 25 of ARPA funds, American Rescue Plan Act funds, to support our operating assistance, the federal monies, as well as the local, to reduce our local match burden. We've got some money left there, not a ton. It was like 1.2, Nick, I think we've got left in that, somewhere around there, available to us to still use in this fiscal year. I covered all those bullets on that page, Nick. Yep.
All right.
And
So,
Tim, if I could just interrupt for a quick second.
yeah,
One of the things I just want to reiterate to our board members, which is something that they already know, is that when we look at what Tim has just told us in the last few minutes, it shows our super heavy reliance on federal funding. And I just want to make sure that there's clarity that if there was any type of hiccup in how federal funding flows, even if the programs didn't change, but the new administration wanted to put a pause on some things, it could really complicate our lives. And so I just want to make sure that, folks know that this is something that we always have to kind of keep in the back of our minds when it comes to, what's in the realm of possibility moving forward.
Clayton, just a quick question. I haven't read it entirely through your report from the conference that you attended with the other small urban operators, but is this something that you talked about there? Like, is this the standard situation that small transit agencies find themselves in, this over-reliance on federal funding?
So there is variability. I will say that we're probably in the, I would say, top third when it comes to reliance on federal funding. I don't think that we're, extreme, but certainly, I think it's about 2/3 federal funding puts us, in a little more vulnerable spot. And in most situations, that's great news. Of course, we want to have as much, paid for by the federal government and less by local, taxes, but that dependency does create problems for us when there's, federal funding uncertainty. I wish that we were in the situation that St. Cloud Metro was in Minnesota, because several decades ago, they wanted to, make sure that transit was funded healthily at the local level, and they use a sales tax. And so they're probably on the low end extreme, where there's only like about a quarter of their funding comes from, federal grants. But I don't see us ever being able to get to that point unless circumstances in Vermont change tremendously.
Great, thank you.
Thanks, Susan. Thanks, Clayton. Paul is now here. Paul, welcome.
Thank you. I apologize.
That's no problem. I am going to shift chair responsibilities over to you, Paul, if that's friendly, as I need to leave in a few minutes.
Thank you, Chapin. Tim, do you have anything more you'd like to add?
Yeah, I'll go over these bullets real quick, Paul. So,
Go ahead.
it is worth noting that with the anticipated transfer of our rural services in July 2026, it is imperative that GMT stay current on our grant applications to the FTA, to ensure there's minimal delay in our ability to draw down funds for expenses incurred. GMT staff, including finance and planning, are also working to streamline the urban grant billing process to expedite our federal drawdowns. I will mention that we just completed our drawdowns, our 5307 drawdowns, probably earlier than we've ever done them in the past. So we've made significant progress and, between planning and finance, just expediting. And that was about $500,000, I believe, Nick, wasn't it, between all of them?
Yeah.
Our PM, our operating, and our CMAC, I think it was about $500,000 that we have submitted the drawdowns, which usually takes about a day after Tammy submits them in ECHO. So I think that's gonna help us quite a bit. Nick and I are also discussing if there's any possibility that we could do our next month's drawdown before TRAMS closes, because the Federal Transit Administration, they closed down the platform. The Transit Award Management System closes down for a period of several weeks. So we're looking at maybe possibility of getting that next drawdown done before they close. As mentioned, I also provide a detailed breakdown of all the GMT's direct federal grants for your review. It's worth noting that, our direct federal grants are separate and distinct from our pass-through grant of funding that we get from Dan, and VTrans in our annual grant agreements, which is, additional urban funding as well as rural funding that we receive. And I just had to.
Yeah, all set.
Just wanted to know if there was any questions from the group.
I'd just like to make a comment. I've heard the emphasis on the need to be really on top of, as I understand it, applying for these federal grants. I don't know if historically there's been a problem with that, but I really hope that if you have strategies on how to do that better than what's been done in the past, that you're developing those and making those needs clear, because I think I agree with you. It seems like it's something really important for us to stay on top of. So I just wanted to make that comment. And then the other thing, this is a bit of an aside, but I see in here also the TOD pass-through.
Yes.
CRPC, and I was just curious if the board will be receiving any sort of a summary of that raise grant finding. So I know that's an aside from what we're talking about here, but I just wanted to put that out there.
We could certainly provide that to the board. I don't know, maybe the Regional Planning Commission would be willing to come and do a presentation of, where they stand. It's the grant really doesn't have a lot of benefit to us. It's a pass-through.
Yeah.
So we manage it, or should I say I manage it. I manage the drawdowns. They submit their monthly invoices to us, and then I do the drawdowns and trams. But it's 100% pass-through to the Regional Planning Commission, but they have to provide quarterly milestone updates to the Federal Transit Administration. I sit in on those calls as well. But we can certainly do a detailed presentation to the board if that's a level of interest there. I did provide a link as well to that, some more information about that grant on the Regional Planning Commission's website.
Yeah.
And Susan, I do want to let you know that last month, Nick, Tim, Matt, and I sat down to do some process mapping to figure out how we can get through these processes faster to get to the point that you made.
Great, thanks.
Yeah, I think we've made significant strides there. As I mentioned, This is probably the earliest we've completed our drawdowns for a month. Since I've been here.
Yeah, no, we're definitely, you'll see it when I present the balance sheet, but our receivables are down significantly over last year, and that's really entirely thanks to Tim, because he's just doing the grants so much quicker than we've ever been able to do. I've got a pretty long presentation to get through, so I'm just gonna get started if there's no other questions for Tim.
Go ahead, Nick.
Okay, great, and I think we lost quorum because we have Paul, Austin, and Chapin left, right?
Chapin left, I thought.
So I just wanna make sure if we did lose quorum or not, taking minutes, but I think we're still
We still
all
have
right.
one, yep, the three.
All right, well, I'm gonna get started. So these are, we're talking year end here. So, obviously, we're sitting here in September, so I apologize for bringing year end financials to you. 3 months after, but that's just kind of our business model. And we're hoping that'll change in the future, especially with the rural side going away. Hoping that we'll be able to get numbers in front of you folks a lot quicker than we have in the past, but for right now, this is really the best we can do. I think this year ended very, very well on the urban side. Not so great on the rural, and we can talk more about that. But as a whole, so GMT had about 30 million in total revenues, a little more in total expenses, about a total loss of $160,000, and net assets went down by $500,000. How that breaks out by division is about a $46,000 loss on the urban side, which, to be honest with you, is historically about where we've ended the year. We need to audit our business or our grant billing practices, because clearly we're missing some revenue, but there's also some timing mismatch that's going on there, so I'm not overly surprised by that. On the rural side, we did lose about $113,000, and we can talk more about why that occurred in future slides. If I can get the thing to change slides, that is. All right, so we're gonna start at the top, just talking about total revenues. I'm not gonna spend a ton of time on this. This is just really a summary of all of our federal, state, and local revenues by grant, as well as our operating revenues. You can see, we came within 5 percentage points on the federal, state, and local. We literally ended the year 1% over on operating revenues. So, in total revenues were about 96% of budget. So if I can be within 5 percentage points of the budget every year, I'm pretty happy. And to be honest with you, we always want to be under in federal, state, and local. So the fact that we ended the year at 95% of grant funding, that means that we're not overspending our grants, we're underspending, with some exceptions, of course, and I'll talk more about that later on. And then with operating revenues, we always want to be over. We want to collect as many operating revenues as we can. We came within 0.5% of our fair estimate. I think that is fantastic. There's some concerning areas. I'm going to go into every line in way more detail, but I just wanted to, give you a quick snapshot of where we ended the year. But I think really, on the revenue side, our budgeting is performing well. The expense side is doing well as also, but there are some areas, where we could do some improvements, and you'll see that obviously as we go through the rest of the income statement. This is how the pie breaks out. This is GMT as a whole, so I want to be clear. We'll look at both urban and rural in a second. And then I like to compare last year to this year. And one of the big things that you'll see is that the federal 5307 funds shrunk from last fiscal year. Other state grants grew, really kind of took on, but a big change obviously was the operating revenues. Went from 3% in FY24 year end to 8% this year. That and other grant funding is really taking pressure off of those 5307 funds, which is really important. And you'll see that more pronounced as we just look at urban, and rural separately. Down below, there's a great table that kind of shows the year-over-year change in funding for all of our grants and operating revenues. So you'll see that, 5307 federal funds were down 28%, on a dollar for dollar basis. So we we spent $1.8 million less in those types of funds. And you'll notice that operating revenues went up by 1.5. So you can see that really, you know, the impact of fares and those revenues, you know, really helped take the burden off of our 5307 funds, which is our biggest challenge in the future, because, you know, as we currently stand right now, the money coming in a given year is not enough for the money going out. The only reason we're able to operate this year and next year possibly with not a huge deficit is because we have some reserve funds that are left over that have built up during the pandemic that we thought were going to be gone for FY 26, but now we expect them to last into 27. But I'll be talking to the board about that this or next week. So we'll dig deeper into that and into the future. Now this is urban broken out separately, not including rural. You can see the change in operating revenues is much more pronounced. So, you know, went from 4% to 11%. Other federal and state grants went from 26 to 32. And really that was what took the pressure off of the 5307 funds. Really just additional funding that VTrans provided in those flex funds, as well as, you know, the operating revenues from largely fares is what makes up the majority of that 11%. So, you know, that really breaks out to be, I had the number actually written down. So that 11% for fares is 9.1% is fares from fixed route, 0.7% is paratransit fares, and then the remaining 1.2% is our other operating revenues like advertising income, you know, investment income, things like that. Looking, I always forget I have this chart in here, but I like to show this every review just to remind you, and this kind of really just reinstates what Clayton was talking about, right? So the reason we got into these financial struggles is because of our over-reliance on federal funding. You can see during the years where, you know, we didn't have as significant financial challenges as we have now, you know, FY12 to say, you know, FY17 or so, you know, we were really only supporting 50% of the organization with federal funds. You know, you can see at the height that got up to 74, and it's actually has elevated a little bit in FY25. And you can see that, you know, the remaining funding sources, which is state and local, have actually gone down, you know, since FY12. And so the organization has shifted the cost burden onto a funding source that has kind of really shut the tap off. And that's, you know, what we have to figure out in the future, because ultimately that purple bar, which is federal funds, is going to have to bend downward. And the other one, two, or both of those other funding sources are going to have to push upwards. And we're going to have to get back to a more normalized, you know, funding mix of probably in the 50s, maybe 55% federal funding, and then with the remainder non-federal picking up the other half of the costs. Looking at rural, not as much of a swing year to year and changes here, so I'm not going to spend a whole lot of time. You know, you'll notice that E&D went up, you know, a little bit, but everything else except, you know, Medicaid, which changed a little bit as well, it stayed roughly the same from the previous years. And, you know, we didn't really expect a whole lot of change. I will say, you know, we did collect about $400,000 less in Medicaid revenue this year. And that program continues to be a challenge both on a financial level and just on a operational management level. But I won't spend a whole lot of time on that here. So looking just, you know, checking in on budget lines for the revenues. We kind of already looked at this previously, but I did want to break it out separately so you can see how the budget performed. As a whole, you know, around 96% of the budget is what we came in at. That differs a little bit between urban and rural, so about 95% on the urban side. And I just want to point out that 95%, that 5% underperformance, or I should say a little bit more than that for federal, state, and local, is really what is driving the change in our forecast for FY 27. You know, we expected all of the reserve funding really to be swallowed up in FY 26. But now we're expecting to be able to carry forward about $1.6 million into 27. And I just want to reiterate that money is one time. That is not a continuing benefit. That will be gone after FY 27. And so, you know, the problem of, you know, this sub $3 million shortfall is not going to go away. It just got pushed out a year essentially. Some lines that, you know, we want to work on for the budget in the future is down below. You know, miscellaneous revenue was a little lower than what we had hoped. You know, Medicaid is always a challenge, but we were fairly close within, you know, 4 percentage points of that. And then the rest is really, you know, our budgeting is driven by our state grant applications. So, you know, the reality is sometimes, you know, there's variances from what we apply for in the grant application from what actually occurs, and that sometimes cannot be controllable. But I think overall, I'm really happy with the performance. Like I said, if I can come within 5 percentage points of the target, I'm pretty happy with that.
Nick, could you talk about the local operating assistance?
Sure.
Budget line?
So
2%?
that is down so much because of the changes with the Jeffersonville commuter. So what happened there, Susan, was when we canceled that route, I reached out to all of the members that contributed to that. So Underhill, Jericho, I think Cambridge is another. And we prorated their contributions and refunded it to them. And that's why we hit only 50% of the budget for that.
Okay. Okay, thanks.
No problem. So jumping down to the expenses, where, you know, and we're gonna just talk about some KPIs real quick before we jump into the budget performance. But we always like to kind of show the transit rate performance over the year. So you can see the rural side a lot more volatile than the urban side. But what is a little interesting is that they both ended the year. And again, this is year to date or an average year to date. So, you know, for example, in August for the yellow line, which represents rural, you know, really that told us that every vehicle hour we operated year to date through July and August costs about $159 an hour. So it's a cumulative average, meaning if you look at June, for both urban and rural, when we got to the end of the year, our per unit cost for service, meaning like per driver pay hour or per vehicle hour, cost about $126, $127, which makes somewhat that makes pretty, it makes sense that they're so close, because really the cost structure is the same for both urban and rural with some small differences. And because capital is not included in the transit rate, which is, I'd say, likely the biggest difference between urban and rural, you know, that's really not an impact. I will say that we have struggled during the fiscal year on the data side for a component of the rural hours. So, you know, so I just want that to be known. You know, I think we have a decent degree of confidence in the rural transit rate, but there were some software challenges that we ran into, as well as just some practices that needed to be changed. And so we're hoping that this fiscal year we're going to see a much lower level of volatility in the rate and just more accurate figures. The urban rate, we have a very high degree of confidence in that is accurate.
And Nick, why do we use a different basis for rural and urban, the per vehicle hour versus scheduled?
Sure.
Okay.
So because we don't use route match on the urban side, so we really have to rely on planning numbers, and it just was a lot easier to grab the hours from the bid and use that as the metric to bill our grants for, because for some of the grants we actually use the transit rate. we also don't capture, you know, actual vehicle hours, and to capture actual pay hours and use them to bill would be quite difficult, because what if a driver is doing 2 separate routes that day and he has, you know, a couple extra hours, you know, it gets, we don't track the payroll so specifically to the route to be able to do that. On the rural side, because we do have route match, it's a lot easier to get the actual hours of service, because a good slug of that service on the rural side is demand response. So we actually have tablet level data for that. So that's why the metrics are the same. But that's a good point, Susan, to know, because obviously the driver pay hours are going to be higher, which will push down the rate slightly, or at least that's my thought there. So they're not like for like perfectly, is I guess is what I'm trying to say. But we like to show them next to one another just so we can compare.
Thanks.
And then, so just looking how they compared over last year and how the rate changed. So looking at the urban side, and again, these are year-to-date rates. You can see that in June of last year, we ended the year about $120 per scheduled driver pay hour. This year, it jumped to $126. The major driver of that rate increase is really a combination between both, you know, the costs, which did go up by about 2.5%, and just a decrease in driver pay hours. Yeah, the double whammy of expenses going up and service level going down, and so that's why the rate increased over last year. On the rural side, the change is a little bit more pronounced, and you can see that much bigger change in the operating expenses. So the expenses on the rural side went up by about 11%, and then the actual vehicle hours went up, but just by not as much of a percentage of the cost, obviously. So only about a 3% increase in the service hours, but much larger increase in the operating costs. And then just jumping down, looking at some other KPIs, looking at the overtime rates. You know, I think you see, and this is where you'll see the biggest improvement, and it's our largest work group, so it's the most meaningful. But urban drivers, this is the percentage of pay hours for urban drivers that are either paid out at overtime or double time. And you can see that, you know, that FY25 purple line is definitely below or at in only 1 month the level of the year before. So you know, I think the service reductions have certainly helped take, you know, that overtime rate down, and you know, that has been also why, you know, the expense performance in FY25, you know, we came in so under budget is partially due to this as well, just not having to pay as high an overtime rate. Looking at urban maintenance, obviously a smaller group here, but you can see that FY25 is a little bit higher than FY24. You know, I think FY25 we had, you know, a much higher level of vacancies, which obviously drives up overtime. So I expect now that you know, we're much better staffed in the maintenance department for this for that line to hopefully go back down closer to, you know, the FY24 levels in the future.
And just to add quickly to that is that we had several folks on long-term recovery from work-related chronic, you know, use injuries.
Yeah. Berlin drivers, you know, not really, well, I should say, you know, pretty volatile. So FY25, you know, it looks like we started the year under, jumped up in the middle of the year. Obviously, seasonal service impacts that, so you got to keep that in mind, because some drivers are going out to drive in the mountains. And then, you know, got much closer down to, you know, where we ended FY24 last fiscal year. So, you know, I think just speaks to, you know, there is a real cost to that seasonal service, and you know, that definitely shows up in the winter months. And then then Berlin maintenance. This is a very small group of people, so I'm not gonna spend a lot of time here. This is literally like 3 employees. I think if you can have overtime rates, and this is a percentage of hours under 5%, you're doing pretty well. So I think doing very well there on the staffing, and certainly an improvement since November over last fiscal year. And then St. Albans drivers, again, smaller group of drivers, but a little volatile. You can see, jumped up a little bit during the fall and winter months, and safely below, but below 5%. So, at least as of June. So I think that's doing very well, and definitely outperforming last fiscal year. Stowe and Lamoille, this was probably the biggest one where we saw a very, very large jump during seasonal service. So about 30% almost, or 29% of hours in April, and then in the mid-20s to low 20s in February and March were paid at either overtime or double time. And then not really the same change in Sugarbush, but I think that's probably a smaller amount of drivers over there. But a little bit of outperformance in the later months in Sugarbush and relative to Stowe.
Nick, in Stowe, was that a recruitment problem?
I don't really know. I think seasonal service is always a struggle. You're trying to find temporary drivers, and some years are probably better than others. And the reality is if you don't have the part-time or temporary drivers, you have to rely on full-time drivers, and those folks are almost always going to get paid overtime to do that work. So I think that's part of it.
Tim, not to put you on the spot, but do some of our seasonal drivers need to leave by April, and is that why maybe that's a high in April?
Yeah, I think so. I also wanted to add that it looks like we're in pretty good shape from what I heard yesterday for the seasonal drivers for this upcoming season. Looks like everybody that worked down there last year is returning, Clayton. So that's a good sign, and that should hopefully drive down our overtime.
Great, thanks.
Also, Nick, I just want to remind you that Stowe had some extra trips last year, which they did get invoiced and paid for, so that also would have affected the hours.
Okay, yeah, no, I remember that. Yeah, and there was some expansion service added 1 year, so I don't know how much of that we actually provided, but yeah.
Yeah, they're always, I know the mountain is always looking for more frequency of service during the weekend and weekends, and we do the best we can with the resources that we have available to us.
That's right. Great. So I'm going to jump down to expenses and just looking at GMT as a whole. Again, very happy with where we ended the year. You'll see on the budget and on the financials I sent you, we ended the year at about 97% of budgeted expenses. I'm sorry, I am talking about just urban here, not GMT as a whole. But so for urban, we ended the year at roughly 97% of the budget. And however, I do like to make an adjustment for those pass-through funds. This is the CCRPC pass-through funds that we do. I think they muddy the performance of the budget, so I like to back out the impact of that. And that's what you'll see here as I deduct the pass-through funds to kind of come up with an adjusted operating expense and budget figure. So you'll see that it was actually, we underspent the budget even more than what the original number was if you factor in the pass-through fund. So really is about 94% of the budget. And again, this is why we underspent our grants by that much, and why FY27 is now looking a little bit easier, because we had that 6% roughly of underspending of the budget. So we'll talk about that more next week, obviously. Some lines, and then obviously there's more of them on the expense side than the revenue that we're going to work on improving in our budgeting process for 26 and beyond. Some of these are a little uncontrollable. So the MPO planning expense, that's really the expense line where the CCRPC pass-through funds go through. And, I had an estimate of 250,000 that I got from Charlie at CCRPC, and they ended up spending more than that. You can see about 830,000. So some of those things are a little uncontrollable. Partner local share, when we talked about why that local operating assistance came in at 50%, well, that meant our expenses are a little bit higher because we had to pay those contributions back in an expense line. And so that's why we didn't expect to do that when we had first created the budget. So that's why that line was so out of whack. Consulting fees, this was largely due to the hiring of a lobbyist. The Neckerson fees, so that'll be fully captured in the 26 budget adjustment, but unfortunately wasn't in 25 completely. Employee development, there was just more training needs than expected. Likely, I think we're gonna have to increase the training budget, and you'll see that when we bring the 26 budget adjustment. There were some dues and subscriptions that were purchased, and we just had more interest in providing that this year, so that'll be another line that will be adjusted in 26. Public information, really the same thing, just higher cost of providing materials for the public than expected. I met with Jamie this year though, so we've updated that budget line. I think there was also some one-time items that came up in 25 that kind of increased the cost that higher than what we typically expected. Miscellaneous operating expense, this is really, again, miscellaneous expenses is a very small portion of the budget. It's, I think, less than $2,000. So, we'll have to look at that and see what cost went to that. I think largely this is usually where we put printed driver materials and things like that too. So I think there was just more of that than expected. Passenger facility expenses is actually one of the lines that will be a benefit to the budget in the future because we updated some of our routes so that we don't have to pay for parking at private lots or park and rides. And so I'm very happy because I had to negotiate those leases every year, and I am not going to miss having to do that. So that's going away, and that's thousands of dollars that we're not going to have to pay anymore on the urban side. So that's actually a budget savings in the future. Repeater fees, these are really subscription fees for the radios we have. There was just more radios than expected. And then other employee benefits, that was really driven by higher disability expenses, disability life insurance, those were the ones. So, but I provide everything within 10%, and anything over 10% is what was included on this line. So, I think we're pretty happy. Most of these expense lines are actually pretty minor, are rather small in the budget. So I guess what I'm trying to say is there's going to be variances. I'm happy it's in these lines and not in like wages and benefits and healthcare and things of that nature. So looking at rural, again, no adjustment needed here because there's less pass-through funds that are volatile in nature. Within 3 percentage points. So again, like I said, if I can be within 5, I'm pretty happy, and at least it's under, not over. I'm not going to go through all of these. I'll just do a couple that weren't captured because a lot of these are kind of the same thing as what I just went through on the urban side. Communications was definitely higher than we expected, and thankfully I have my new staff accountant Rich has been working on that and meeting with some of the vendors that we use. We're actually updating some of the agreements and going to save some money there. So I think you're going to see communication costs coming down next fiscal year. Unemployment tax, just another thing that the cost of seasonal service. A lot of the folks that are on that are folks that drove in the mountains. So there is, a cost to temporary labor. Not all, but some of the impact there was related to that. I'd say computer service expense, that was, really just route match costs. And those are really almost entirely covered by V-Trans. So, the overage was actually additional revenues were provided to cover that overage. And then, travel and meetings, that's a relatively small line. We did start paying, I think, drivers to commute between mountains if they were asked to. So that likely was the impact there. But like I said, I'm very happy with the performance. Within 3% is I think shows that our budgeting processes are pretty sound here at GMT. And then we'll talk about the bottom line. Like I said, the urban side really mirrored last fiscal year. What this does kind of say though is we are missing some expenses somewhere in our grant billing processes. So this year we're gonna really audit, the processes and figure out where that $46,000 is coming from. Again, this might simply be a deferred cost or a timing issue, but we want to make sure and confirm that. But just so you know, this literally amounts to like 0.2% of the urban revenue. So it's not a huge variance, but we'll certainly be looking into that this year. I think a better metric to really judge how we ended the year is look how we spent our grants. And you'll notice that CMAQ and 5307 especially, we underspent those grant lines. And the most meaningful one is that federal urban formula grant, which is our 5307. You'll see we had underspent that by over 20%. And again, we'll talk more about this next week, but that is really the driving force of what made our short-term outlook change for 27. The rural side, a little bit higher of a loss, about $113,000. You can see that's a pretty big swing from last fiscal year, which was $870,000 gain. Really, this was driven by just, I think we ran out of 5311 funds in March, right?
Admin we ran out in March, and PM we ran out in April.
Yeah.
For about a maintenance.
And then we ran out of ops in
June.
So
Yeah.
we ended up having to put a lot more local funds into into some of our grant programs.
And we overmatched the state funds as well.
Exactly. And so that, obviously brought down our revenues. And then, Medicaid also with an impact here, year over year, we saw a pretty dramatic drop in our Medicaid revenue. So that combined, thankfully we had some operating revenues that outperformed, or the loss would have been a lot worse. But this will be covered. We have a healthy fund balance, but we want to keep it that way. And so obviously don't like to have losses, but I think this year we understand the loss, why it occurred, and we need to talk at some point, and we will, about FY26, because the rural system is also showing a very large loss in that fiscal year. So, like I said, we'll be dealing with that next month when I bring the 26 budget adjustment to you folks. And I'll end with just talking about balance sheet, investments, and a couple other things. So if you look at the balance sheet, you'll see, and this is not audited, so I want to be very clear that this is subject to possibly change based on the audit results. But you'll see the balance sheet actually shrunk by about $1 million in FY25 over FY24. Part of that is really just a drop in liabilities, about a $500,000 drop in current liabilities, which is good. But you'll also see that we had that loss that came in, that change in net position that was negative. And that will likely be spread, I wrote it down, it will be spread pretty evenly between our unrestricted net position, which is essentially our fund balance, and our restricted net position. I'm sorry, I lied. It's largely going to be covered by our unrestricted net position. About 54% of that $499,000 change will be a reduction in our fund balance. 14% will be about a reduction in restricted. I keep on screwing up the numbers. I'm sorry, folks. It's about $159,000 share will go to unrestricted, $269,000 will go to restricted. So it's actually largely a drop in our restricted net position, and about $71,000 into our fixed assets. I guess the only thing I want to point out here is you know, our largest long-term liability continues to be CTO. We paid out $225,000 in cash outs this fiscal year. So even with that, you know, our liability still went up by 2.7 thousand. So I just want to continue to reiterate the cost of CTO, you know, at GMT. This is just wanted to give an update on the investment portfolio. Really, this is one of the large reasons we didn't have a bigger loss than we did in FY 25. You know, we made about $158,000 in investment returns. Since inception, we've made about $390,000. We've got about $3.8 million in there as of June. So, you know, hopefully interest rates don't get cut dramatically in the short term because, you know, we're certain this has been helpful to the operating budget. And then just ending with capital investments, you know, the urban and the rural side here, these are just some of the items that we saw added to the balance sheet as of June 30th. So I won't go through all of them, but you know, some vehicles, obviously a lot of charge management and electric vehicle related investments. On the rural side, we had about 12 Turtle Top buses, 4 minivans and a shelter. In total, over $5 million of capital investments done in FY 25. And then just some items that, you know, we're working on and hoping to have done over the next 12 months. You know, obviously next month I'll be bringing you folks the proposed FY 26 operating budget adjustment. And then shortly after that, I'll be bringing you the 27 operating budget as well. We're focused on the rural transfer, and then some procurements we're trying to get done this year is for an accounting consultant and software, as well as insurance services. And then shortly we're dealing with the FY 25 audit, and we'll be bringing that to you folks for approval in February. So I'm sorry, I know that was a lot, but it was the end of the year, and I wanted to make sure I spent the time I needed to, and happy to answer any questions for you folks.
Questions for Nick or Tim? Nick, maybe you don't know this, but the attrition rate has been pretty significant during the past year or so. If that's continuing, are we going to run back into a shortage of drivers that will require more overtime?
So I track that pretty closely with Jimmy. I talk to him quite frequently about, you know, what we're seeing there. We did lose, you know, definitely. I don't think it's a concern right now, given that we have reduced service. And I also think that sometimes it pays to have a higher overtime rate, especially if you're an organization where the benefit costs are so high. I would say that overtime's down over where it was last year, and we, you know, have a lower driver count. So I'm not seeing a huge impact yet in that, but all it takes is 2-3 folks to go out on workers' comp or disability, and then you've got a real problem on your hands. So I think we're probably right where we need to be right now, given the service levels, but we don't want to lose any more. You know, I think any more and we would be concerned. And Paul, this is part of the reason that, you know, 27 is looking better as well, because, you know, had a pretty dramatic drop in, you know, driver headcount. And when healthcare could be as much as $30,000 a year per person, you know, the budget shrinks quite a bit. So, you know, I think my healthcare budget dropped by $200,000 because of, you know, not just that, but some other changes in the organization. So.
Thank you, Nick. Any other questions for Nick or Tim? If not, is there any other business to come before the Finance Committee? We don't have a quorum any.
Yeah.
So
I'll have to figure out when we lost it too. So we'll have to go back through the recording, and we actually did the transcription. So we'll figure that out, Paul. Yeah.
Well, that's another meeting that we can't adjourn. So sorry about that. We'll be in session now for another month. Just behind the scenes. All right.
Well, I want to say I sent out all of the presentations to you folks, and I know I whizzed through things pretty quickly there. So if if anybody has any questions, feel free to email me or Tim. We'd be happy to set some time aside and walk you through anything we might have gone through too quickly.
Well,
Nick,
it's
I
very
just want to thank you for doing that. It's really helpful, at least for me, to be able to run through things before listening to you go through it. So I know it's a lot of work to get it out in that kind of timely way, but it is really helpful and I appreciate that.
Happy to
Absolutely.
do it. Thank you.
Yeah, good work. Thank you very much. All right, folks, we'll
Good
see you
work.
probably on Tuesday.
Bye, everyone. Have a good day.
Bye, Nick.
Everyone,
Bye.
bye.